Hi students, I wanted to go over chapter 16, section 4 of the cash budget. This is a worksheet that's in this review spreadsheet XLS I'm going to send out to you. On the bottom it's 16.4 cash budget, but I wanted to kind of walk through it with you so you can understand it and hopefully clarify any questions you might have. This starts out on page 536 in your textbook, and basically what you have here is the example provides a cash budget for a company that is using cash budgeting to manage receivables and payables. So the way this works is typically you'll have a quarterly sales forecast, and that is what's in row 8. 200 million for Q1, 300 million for Q2, 250 for Q3, and 400 million for Q4. Now you have a beginning receivables balance of 120 million, and you have a collection period average of 45 days. Remember, as I said in class, the beginning receivables balance is always the ending balance of the prior quarter. So for example, if this we're talking about Q1's beginning balance of being 120 million as given in row 10, and I think it is D110, D10, cell D10, 120 million. That balance on Q1, January 1st of the first quarter, is the same exact balance as December 31st of Q4. Okay? So how does this budget work? Well, what they described in the example was a process whereby receivables are collected at the rate of 50% of sales received. That's a given, and I actually put that in row 15. You see it's in red, 50%. So in the first quarter, for example, sales are estimated to be 200 million. So we know from the given that percentage of sales received in the quarter will be 50% of that. So 50% of 200 million is 100 million. We also know that the collection period is 45 days, and we started the quarter with 120 million in receivables. So after 45 days, that 120 million is collected. So that goes away, and then now the other collection is 50% of the current quarter sales, which are estimated to be 200 million. So 50% of that is 0.50 times 200 million is 100 million. So what was collected? Well, 120 million, that was the beginning receivables balance because we did it in 45 days, and then 50% of the current quarter's sales, which is another 100. So that's 220. So if you look on rows 20 in the spreadsheet, you'll see beginning receivables balance 120, sales are 200, cash collections are 220, and ending receivables balance is 100. Again, the beginning receivables was collected, 50% of sales of 200,000 or 100,000 was collected. So 120 million plus another 100 million, 50% of the 200 million in sales was collected. You add those two together and you get cash collections of 220 million. The ending receivables balance is pretty simple. It's the other 50% that was not collected of the quarter sales estimate of 200 million, or 0.50 times 200 million, or 100 million. And that's that ending receivables balance, row 23. So we talked about the receivables and the collections and how much cash was collected. That's in bright red, 220 million. What happened with cash disbursements? And the book goes through the example of telling us the cash disbursements will be in accounts payable, payments, wages, taxes, dividends, capex at different times. And I created a table for this as well. It starts on row 40, and accounts payable are made at the rate of 60% of the quarter sales. So 0.6 times 200 is 120, and you see that in row 41, that's there. So 0.6 times 200. Wages, taxes, and other are at the rate of 20% of sales. So 200 times million times 0.2 gets you 40 million. Capital expenditures were going to be made in Q2, so there's nothing there for Q1. And interest and dividends are fixed at exactly 20 million. So when you add up the cash flow out in Q1, you get this variable amount of payment of accounts at the rate of 0.6 times the sales rate, a sales figure, or the estimated sales figure, to be exact. 20% of that estimated sales figure goes to wages. That's the second line item in row 42. And then you add the last thing, interest and dividends, which is fixed. When you add those up, the cash outlay is 180 million. And how does that compare to cash in? Well, refreshing your memory, our cash collections were that original 120 million in accounts receivable that carried over from Q4. We collected that after 45 days. And then what was left to be collected was 50% of the sales figure for that quarter, which was 200 million times 0.5 or 100 million. So you add 120 plus 100, you get 220, which is in row 50. And then we just went through the cash disbursements to get that adds up to 180. So net cash flow in was 40 million. 220 million divided by minus 180 million. And that gets you 40 million. So you can see that as you go across, it changes by quarter depending on what's happening. I can look very quickly at Q2, and you can go through this on your own, but I can see why the cash flow really went negative by a lot. You see it's 110 million out in red, and that's in row 52. And that's because line 43, there's 100 million in CapEx. So you have 100 million in CapEx going out, and that's really draining cash in the quarter. And you also had just more accounts payable going out, and going out at a higher rate than sales are coming in. You have to remember the rate going out for accounts payable is 60%, and the rate that's coming in is 50% of receivables. So at some point, you'll start to see this turn negative. So anyway, I hope that's helpful and you can understand what's happening there. If you have any questions, give me a call, send me a text, or send me an email. Good luck with your studying.